if you're a homeowner, if you're an owner of a commercial property, you need to actually transact and receive these services from a lawn care company. And so they're recurring in nature in that the grass always grows, the bushes grows. And so month after month, you need to come back and actually service that account, which is a feature of that business model that's very attractive to private equity.
Hi, I'm Paul Giannamore. I wanted to welcome our new subscribers to the channel. You know, historically, Potomac TV has been focused on business and operational information and interviews for residential and commercial services business owners. But after the publication of the Sell-Side M&A Masterclass last month, my LinkedIn inbox has been inundated with a variety of different requests. So Dylan and I will be sitting down filming more extensive M&A masterclasses, both focusing on the sell side as well as the buy side. I intend to talk about the choice of process, delving deep into M&A psychology, as well as extensive buy side practice, approach, and due diligence. For those of you who have not subscribed, you can click below and subscribe to the channel. Furthermore, we've provided a link here in the description where you can get on our email distribution list. And if you do that, you'll receive an email right in your inbox with our latest publications. Feel free to put a comment below on the types of things you want to see. I mean, this channel is largely driven by you, the viewer, and what you want to see from us. Again, thanks for joining us here at Potomac TV.
All right, Nick, live at NALP. We're going to talk some private equity today.
Let's do it. Yeah, happy to be here.
You know, we just had two private equity-backed lawn care businesses here on the stage. We talked to Sensky Services as well as Save-A-Tree, and I've known Daniel Van Starrenberg for 15 years now. He built that business literally in a backyard, grew it to around 40 or 50 million in revenue, and then ultimately recapped it with a private equity firm. So activity from private equity is prolific across lawn and landscape. So that's what I want to talk about today. And I want to start with, what is a private equity firm?
I think it's a good question because it's a term that a lot of folks in the lawn industry actually talk about, but I'm not sure all the time that everybody really knows what it is. And sometimes they're afraid to ask, unfortunately. So if you think about what private equity is, okay, so private equity is essentially starts with an investment advisor. So a private equity investment advisor. And essentially all that is a group of individuals who have come together, sometimes either from investment banking, sometimes from another private equity firm, and they've gone out and they've raised money, okay? And typically where they raise money from would be large endowments, big state pension plans. It could be from wealth management firms, high net worth individuals, family offices, those types of folks, who then give their money to an investment advisor to invest in private businesses or an ownership interest in private businesses. So if you think about private equity, it's just another investment option for a large institution or a collection of individuals that they can invest in relative to, let's say, public equity, which everybody knows would be anything on the stock market. It could be versus bonds, either government bonds or corporate bonds. It could be versus commodities or real estate. So private equity is really just another investment option, and it happens to be in the ownership interest or the equity in a private business, okay? So that's essentially what a private equity fund is. And so you have this investment advisor that's raised money, and now they need to think about what they're going to do with that money, okay? So they will go through a thorough investment process to analyze what actual vertical or what industry they're going to invest in, and they take it from there. Any thoughts that you have about that, Paul?
Yeah, I think it's important to keep in mind that, you know, most private equity funds that are managed by the financial sponsor or the private equity advisor tend to be limited duration funds, right? They tend to be, you know, an average would be a 10-year closed-end fund, where the investment advisor or the private equity fund is the general partner and contributes capital to the fund. And then they go out and, exactly like you said, they bring on limited partners, who are the endowments and the institutional investors and so on and so forth. But they're doing this for a limited term, and the structure of the fund at the very front end of it, you've got the capital raising, then the deployment, going out making acquisitions, growing those organically as well as through add-on acquisitions, and ultimately disposing them. So I think it's important for folks to keep in mind that the investment horizon for a private equity firm into a privately held business tends to be anywhere between 3 and 7 years, right? And
That's right.
obviously when asset prices are higher and the market's very frothy, that tends to be for a shorter period, right? They can sell and make a greater return. When things slow down, they tend to hold for longer. But that's typical of what we see from a private equity perspective. And to your point on the thesis-driven process, earlier on the stage today, we talked, like I said, to some private equity-backed lawn care businesses. GTCR, one of the backers of Senski, tends to be thesis-driven, which is first determining what sort of industries they want to be in and focusing on kind of a top-down approach versus being opportunistic and just determining, hey, what company's for sale, what can I buy, irrespective of the industry. They're actually looking at that. And I want to talk to you a little bit, Nick, about the fundamentals of lawn and landscape and why it actually makes sense for a private equity investment.
So if you think about the fundamentals of the lawn care industry, and this is something that the private equity firms do a lot of due diligence on before deciding to enter an industry like lawn care, the first thing I would say is that in general, a lot of the lawn care related businesses have recurring revenue. So these are services that if you're a homeowner, if you're an owner of a commercial property, you need to actually transact and receive these services from a lawn care company. And so they're recurring in nature in that the grass always grows, the bushes grows. And so month after month, you need to come back and actually service that account, which is a feature of that business model that's very attractive to private equity. The other feature that I think that's quite appealing to private equity is the lack of economic sensitivity when it comes to lawn care. So clearly in landscaping and big construction projects, those can be deferred. But when it comes to maintenance and, think about fertilizer or weed control, those are aspects of lawn care that are really not economically sensitive as opposed to, let's say, a larger construction project. Another feature of the industry that's appealing to private equity is the fact that less people are actually mowing their own lawns, right? Or doing other fertilizer work within their own lawn. Whereas back in our day, right, when we were kids, our dads were recruiting us, hey, you have to mow the lawn, I'll give you 50 cents, something of that nature, right? Where now homeowners continue to outsource those types of activities. And so most people, or not most people, but a lot of people or less people over time are actually mowing their own lawn and treating their own lawn. So what that creates, it creates an industry that's not that economically sensitive, but yet grows on a secular basis because some of these qualitative trends. And frankly, that's something that private equity firms look at. They want a large, growing industry that's growing well in advance of the overall economy or GDP. Would you add anything to lawn or private equity and lawn?
Yeah, I would. And I would say that I think you're right about the appealing nature of lawn from a recurring perspective for private equity. But we've seen extensive private equity interest over the years in traditional landscape. If you take like Brickman, Monarch, all of Yellowstone, you've got a lot of big traditional landscape and landscape maintenance. Now, granted, the landscape maintenance, of course, is a key attribute to that. But I would say that fragmentation in the market is important. And so given that these are very, very fragmented, when I say fragmented, I mean there's literally thousands of these sorts of businesses that can be acquired. And so, the theory is you're a private equity firm, you've got a roughly 10-year horizon for a fund. You want to make an acquisition, you want to buy a business that's in a fragmented market so that you can go out and do accretive acquisitions. And what I mean by that is you can, on the small end, the smaller businesses, you can pay lower prices and build a much bigger business. You can use leverage to make those sorts of acquisitions. And by integrating them, you hope to get not only revenue enhancements, but cost savings, add on additional capabilities. And now you've got yourself a real investment. So we saw that significant. We saw the financial sponsors' involvement first in traditional landscaping. Subsequently, I mean, if you think back up until November of 2015, lawn care was effectively a duopoly in the U.S. You had TruGreen and Scott's Lawn Service. You got a lot of regional players, but you didn't have private equity firms particularly involved. In November of 15, TruGreen acquired SLS from SMG, Scott's Miracle Grow Company, making it, of course, further making it the largest lawn care business in the U.S. But it wasn't until around 2019, 2020 where a lot of the financial sponsors started to invest in regional lawn care businesses.
And before you continue on that path, would you mind, because I've gotten a lot of questions even here about what's a platform? What's an add-on, right? So in thinking about this evolution from only a few acquirers to now a financial sponsor-driven market, could you just walk folks through what a platform is in lawn care and then an add-on?
Yeah, I mean, when a private equity firm is getting into a market, it's got to buy a platform, right? And it needs to typically would want to buy a business that's large enough to have a management team to operate at scale. So depending upon the industry and depending on the private equity firm, like for example, you have like a KKR or a Blackstone, a very large asset manager, Apex, which owns Save-A-Tree. We talked to Save-A-Tree earlier today. Apex is the second private equity firm. They bought Save-A-Tree from the prior private equity firm that owned it. Right. Mm-hmm. The first private equity firm was a middle market firm, so they were focused on businesses doing 50 to 250 million in revenue. That business now is almost a $500 million $500 million revenue business. Needs a much larger private equity firm, a much larger fund to buy that. So depending upon the fund size, a $10 million revenue company for a lower middle market private equity firm, that's a platform. To a Blackstone or a KKR or an Apex, that's not even anything that they would look at. At best, that's a small tuck-in. Mm-hmm. So it depends upon the size structure of the funds. But really, when I think about platform businesses in lawn and landscape, you're typically looking at firms that are 10, 15, $20 million or above. You're typically thinking about smaller funds where that's okay. That's a decent sized way to get into the market. And then we'll see add-on acquisitions. Might be $500K in revenue, might be $1 million, might be $5 million. Save-A-Tree now, a $6 million acquisition is a tuck-in, whereas a $6 million acquisition back in 2010, when the firm was doing $38 million in revenue, is a very different story.
That's a good point. And I think it's important for the lawn and landscape business owners to understand that if you are a platform versus if you're smaller and you're an add-on acquisition, the valuation multiple that you're likely to receive when you sell is most likely going to be significantly higher if you're a platform. And so the point being is that platform companies, given the fragmentation in the industry and the number of small lawn and landscape businesses, platform businesses are much more rare. And when you have multiple private equity firms vying for those assets, it creates a lot of competition. I mean, something that you obviously know a lot about in thinking about negotiations, running a sell-side process. When you're able to actually have a potential platform acquisition that might have 10, 15 potential acquirers, it gives you an opportunity to really drive the price up through that competition, whereas an add-on acquisition, you might not have as many companies vying for that property. Is that fair?
Yeah, I mean, like when something could potentially be a platform acquisition for multiple different buyers, whether strategic as well as private equity, you're right, the scarcity value and the increased buyer pool increases competition, which lifts prices. If you're the size of being a tuck-in acquisition or an add-on, you're kind of at the mercy of which companies already are in that market.
That's right, yeah. Because you're really an opportunity for them to increase route density in your area.
Correct. Now, I wouldn't say, look, sometimes an add-on or a tuck-in, and I use those interchangeably sometimes, a small bolt-on acquisition can yield the same sort of transaction multiple as a platform business. But if I had to choose, I would prefer to be a platform acquisition, not just from a valuation perspective, but also a role perspective. And I know we'll talk a little bit about that later in the discussion. But if you're a if you're a platform acquisition and you're going to partner with a private equity firm and basically roll equity and literally become their partner, you're actually getting in on the ground floor when the value of the stock is low. And we'll talk about that.
The other item that I think it's important for folks to understand and to bring up as it relates to just this background on private equity is how these deals are financed. Okay, so we walked through the example on a private equity investment advisor raising money and then going out and doing acquisitions. However, when they actually do the acquisition, they don't just use the money that they received from their large investors. They actually use debt as well. And at times, the debt levels can be quite substantial. Let me give a little example on that. Let's say you have a lawn and landscape business that is being acquired for $100 million, okay? The private equity fund or firm will take around $60 million from their private equity fund, so the money that big endowments or pension funds have given them, and then they'll go out and they'll borrow the other $40 million. So it's a $100 million deal, they take $60 million from their fund, and they borrow $40 million. So there's essentially a 40% loan to value ratio on that acquisition that they're making. And you can imagine that the interest rate environment clearly impacts that acquisition decision. You know, if interest rates on private equity debt or direct lending was 6.5%, like it was back in 2020, 2021, when interest rates were very distorted, when the Federal Reserve was at 0%, that's a very different financing environment than today when it's about 10, 11%, or maybe a little bit more to finance these deals. So that can have an impact on valuation, but it also, I think, illuminates the private equity firm's desire to have a business that isn't that economically sensitive and has recurring revenue. So lastly, it also gives them the opportunity to earn a higher return on their equity. And what I mean by that is since they're only taking $60 million from their fund and borrowing 40, they're trying to earn a return on the 60, okay? And so if you use more leverage, you then can earn a higher return on that actual equity component of the private equity deal. So that's a bit about how leverage or debt comes into play in private equity. I think the other area that we should touch on is value creation. And just to really, we can get into detail in later episodes, but thinking about value creation specifically in lawn and landscape. You want to elaborate a bit on that, Paul?
At the end of the day, the private equity model is one of consolidation, at least right now with regard to fragmented industries like lawn and landscape. So you're going out, you're consolidating, and that allows you to eliminate a variety of different costs, right? Then you're able to spread, if we think about these sorts of businesses, there are a lot of variable costs. If I focus on lawn care, for example, the majority of the costs on the P&L, 30+% of that is labor. And a lot of it is direct labor, right? And so when you consolidate, you're able to not only remove some back office costs, you're able to centralize things. So you're able to create some incremental increase in margins. But from a value creation perspective, this starts even at very basics with what you just said. Let's talk about the ability to go out and if you and I owned a lawn care business, we would not be able to borrow in the same way a private equity firm can, right? And so we can't afford to compete on acquisitions. We can't afford to leverage. And so our money would be more expensive. And what I mean by that is you and I would have to use a lot more equity. And so from a value creation perspective, just from pure financial engineering, we see a lot of value creation on the private equity side. What's your thoughts on that?
I think that's right. I mean, I think if you and I were doing it, or if an operator has a business that would be considered of platform size, let's say 10 million or above for a lawn and landscape business, I think their ability to take financial leverage in order to go out and make acquisitions was extremely difficult. And typically what we would see is seller financing in that situation. So 10% down, 15, 20% down, and then the actual seller, you're paying back the seller over, some period of time. And so on the financial engineering standpoint, I think that's very difficult. On the operating enhancement side, I do think there are some advantages, particularly if you're operating in one area, to use that greater amount of scale to gain efficiencies. So that could be achieved through route density. It could be achieved through using your marketing scale or essentially using the same amount of marketing dollars in a particular market. And now, since that market is more dense, you're able to spread those dollars out over a greater customer base, which leads to higher margins. Those are two of the factors that I'm thinking about. And there's a litany of other factors to create efficiencies.
Yeah, I mean, like when I look at these businesses that were privately held, were acquired by private equity, and then have been able to grow under private equity, I see a lot of things. I see corporate governance. Now we've got
Huge.
a real CFO in there. We've got real monthly board meetings. We've got quarterly board meetings. We have a lot of oversight. You see a dramatically increased use of technology, investment in technology, and one of the benefits that you always think about from a value creation perspective is if you are a portfolio company of a private equity firm, you are typically in a portfolio, which means that you have a lot of peers, other CEOs that are running other businesses within the portfolio. So if you look at any private equity firm, depending upon the size, they might have 5 investments, they might have 500, meaning there are a lot of other people like you in the club. And so the exchange of ideas, not only from a strategy perspective, management, financing, operations, software,
Marketing. You may have,
you name it.
A search engine optimization expert, online marketing expert who specializes in customer acquisition for home services in general. That can also create a lot of efficiencies on lowering customer acquisition costs for your lawn and landscape business. Another area just in this background intro that I think would be interesting for folks is equity roll or rolling equity. So a lot of folks, again, have heard that term about rolling equity. I guess our private equity friends like to call it partnering, right? But essentially what rolling equity is, or an equity roll is that if I go out and I acquire Paul's lawn and landscape business, I'm going to give you, let's say I'm acquiring it for $100 million, okay? And you're going to make the decision, or we're going to collaborate on the decision about how much cash you're going to get up front and how much equity or ownership stake that you currently have that you're going to roll into the private equity-backed private equity-backed lawn company. So could you kind of take it from there, Paul, and elaborate on that? What happens next?
Yeah, I mean, effectively, it's the proverbial second bite of the apple, right? These guys like to talk about.
Of course.
So we take the $100 million business. What would be typical? When you look at private equity investments, you typically have a control buyout, right? We call it a buyout.
Yeah.
And that's usually, 70, 80, 90, or 100% of a business. And then, of course, you have a growth equity investment or a minority investment, and that's typically less than 50% of the business. Mm-hmm. Now, those sorts of things happen for a variety of different reasons. The extreme majority of the transactions in the green industry are control or buyouts. And that's when, if I use your example, the $100 million player, you got a $100 million enterprise value, a private equity firm comes in and buys it from us. They might write us a check for $80 million at the closing, and we're taking $20 million and we're rolling it into the stock of the company. And whether that's whether we're an add-on acquisition or a platform acquisition, we're effectively investing in the portfolio company of the private equity firm. And the great hope is that we take the money off the table, we de-risk our lives, we potentially continue to work for the business, but now we can buy the things we want to buy. We're not worried about all of our capital and all of our net wealth tied up into that business. We can play a little riskier, right? We can take more chances. And then we work alongside the private equity firm to grow that. And so when the PE shop wants to exit 3, 4, 5 years in the future, we're hoping that the 20% or the 20 million that you and I rolled is worth at least as much as we got on the upfront, which is 80 million, which is what we hope for.
Yeah, you may get anywhere from 2, 3, 4, or 5 times your money on that equity roll, depending on a litany of factors. And we'll go through those in another episode. But I would also add that equity roll also allows for effective tax mitigation strategies, because many strategies that we're rolling out from an investment perspective require that an owner actually has capital, okay? And in that situation where your business is acquired, you get a big check, but at some point, maybe it's 2 years down the road, maybe it's 7 years down the road, if you have the capital and the ability to plan with that amount of time in the future, there is a lot of tax mitigation strategies that we can implement in order to reduce that tax bill or potentially eliminate it in some cases. So that's another feature of the equity role that is quite appealing during that, let's call it the second bite of the apple.
That's right. Well, look, Nick, I think that was a healthy intro here to private equity in the lawn and landscape space. I think you and I can maybe get into some details on a further discussion.
Yeah, and really what we want to do is demystify some of these terms and topics that folks have heard about, but maybe are afraid to ask. So let's kick off the next episode.
Sounds good. Thanks, Nick.